Just a reminder, nothing I share here is financial advice. This is all based on my own experience, my strategy, and how I see the market. You're responsible for your own trades, so always do your own research, manage your risk, and never trade money you can't afford to lose. This content is meant to help you learn and think for yourself, not to copy or follow blindly. Let's keep it educational and intentional. Hello guys, let's see what we have. Yesterday, we marked out the 50% wick of the previous weekly candle, mainly the lower part. That's where I was looking for the first reaction, filling half of the wick, with confluence from the 1 hour swing low, where we could see an SFP. That was also where the weekend lows were sitting. At the same time, the 1 hour structure was still intact. Price made a higher high, broke structure to the upside, and with that formed a new main structure swing low. In that case, we then want to see a higher low or an SFP of the lows because the weekly open was more or less a magnet and there was no proper swing low at the weekly open. It opened and went straight up. That's not a good weekly low. That doesn't mean price can't go up, but very often you'll see the market come back to fix the open and form a better low or high. So with that in mind, I was looking for the next level, which was the 1 hour swing low, together with the confluence of the 50% weekly wick equilibrium. Then near the New York Open, we saw a small range and an SFP of that low, and from there, price moved up. As it stands now, the local lows around the weekly open are not very clean. So if this area turns into a range, this would be the area to watch for a potential sweep, meaning if we get a rejection, these lows are likely to be taken out. Now switching to the cycle chart, we can see that we're slowly coming into the daily cycle time window. Price doesn't have to go down. It can also move up first and, for example, form the daily cycle low while grinding higher. More often, however, price shows a retrace into the cycle low. That means if we don't see a breakout from here, price could spend a bit more time in this area, and we need to be prepared for that scenario. If price just shoots up from here, that's fine. There's not much preparation needed, just sit back and enjoy the move. But if it retraces, then we want to look for a higher low. Or for those interested, potential short setups as well. So with that said, we're slowly entering the time window, and now we'll watch where price could fail or where a higher low might form. Now on a nearer time frame, I'm still looking at this level, the 2-day order block. If that fails, then we look lower, but always step by step. The next bigger level would be this OB area. I've also marked out levels where we could see reactions to catch a runner. 2 of them already gave a nice bounce, while 1 remains active. If price moves up from here, that's great. If not, the next level sits slightly below. Today's average loss is also around this area. That would also mean price is losing the Monday range. In that case, if a trade is taken from the lower level, one would need to watch the reaction on the Monday low retest and potentially take some profits if it's a day trade or a scalp. If this level gets reclaimed, then we look back toward the weekly open and the Monday low. A bullish sign would be holding this area and reclaiming the weekly open. A sign of weakness would be moving back inside, retesting the weekly open, and then losing the Monday low again. From there, we'd need new data. On the upside today, the average gain sits around some structure stops, as we can see here. That's a nice confluence, but it could be a bit turbulent since there are several levels close together. If price moves up there and starts to hold the Monday high, it could form a higher low and then take out the remaining highs. For a short setup, you'd want to see price move up into the range, fail to hold the Monday high, and then retrace. Ideally with a structure break and some divergence on the retest. That would be the setup, with targets on the way down at poor lows or SR levels like the weekly open, Monday low, and so on, depending on your plan. Looking at the CVD data, we can see that while price has been grinding up, CVD was bullish within the range. Now, however, price is making higher highs and higher lows, while CVD is moving down and open interest is rising on the drops. That suggests fresh shorts are entering the market and someone is absorbing them. We'll see how this develops. For today, I'm simply watching the Monday range and the averages as deviation zones. From there, it's about seeing whether price can reclaim or hold the levels it broke. If we see an increase in volume, and for example, the Monday high holds well, then a move higher is possible. The same logic applies on the downside. Inside the Monday range, if you're looking for a trade, an SFP of the lows with confluence from the weekly open and the local range point of control would be the setup. Here, you need to see whether price can reclaim today's open range. If it does, I'd aim for the Monday high as the next level. So this level is both a potential TP for a short if a setup forms and a level to look for a long. Ideally before taking out the Monday high, since it's always nicer to have clear highs as targets. And that's basically it for today. Summary for today. Price is still moving within the same range, and the approach remains unchanged. Trade it level by level. We are also slowly entering the daily cycle time window. Price doesn't have to drop immediately. It can move up first. But more often, we see a retracement into the cycle low, so we stay prepared for that scenario. What matters most is where price is when the time window is reached. On the lower time frames, the 2-day order block remains the main area to watch. If it fails, we look lower step by step while respecting the reaction levels that can provide bounces and potential runners. The Monday range and the weekly open are the key short-term references. Holding and reclaiming these levels is a bullish sign. Losing them and failing to reclaim is a sign of weakness and opens the door to lower levels. Today's average loss and average gain act as deviation zones. Reactions around these areas help define whether price wants to continue higher, range, or retrace. From a data perspective, CVD and open interest suggest fresh shorts are entering and being absorbed. How price reacts around these key levels will tell us whether that continues or fails. For now, the plan stays simple. Manage existing trades, respect the range, let price come to the levels. No rushing, no overtrading. We wait for clean reactions at key levels and adapt only when the data changes. With that said, I wish you a nice day, and I'll see you in the next one.